Hello, welcome back to my network. I'm joined again with Henk de Hoop, the CEO of SFA Oxford, and we're here again to talk about platinum, palladium, and all things PGM. So, Henk, good to be with you again.
Pleasure.
Look, we spoke about a year ago. I think the PGM market was worsening then. I think it's fair to say it's worsened since then. Why don't you give us a bit of a recap as to what the main themes of this industry have been over the last year and how you've been reading it?
Okay, I guess important is always to take into account in any commodity analysis what is the macro background. And if I compare then to now, we then already expected these high interest rates to start affecting economic growth rates. And we are seeing the effect much clearer now, where we're seeing clear signs of stress in the US economy. We are not seeing China accelerating as was hoped, perhaps through some stimulus program, and they certainly have given indications that it's not going to be a typically commodity heavy incentive program that they're going to throw into the 5-year plans to re-accelerate the economy. It's shifting from property, capital intensive infrastructure to more the high-end tech side of things. So Europe, on top of that, still affected by what happened in 22, energy crisis, followed by Ukraine, followed by, I guess, general higher interest rates as well. So we're not getting much help from growth rates there. German economy struggling, UK economy struggling as well. So the overall picture for economic growth is not that great, and that doesn't help commodities. And we've seen that in a lot of the commodities, be it lithium, nickel, and copper, and the PGMs, and all of them have their individual dynamics, but it is not a good environment for commodities. And I think that's important to keep in mind. I think with PGMs specifically, what has helped PGMs at least to have an underpin is car sales have started to recover. Probably this year, marginal car growth on 2023 numbers. We should, although there's a lot of bad news on BEVs, which indirectly is good news for PGMs, they are still gaining market share to a certain extent. And I think important to remember as well is what is the biggest car market in the world? It's China. Who are the biggest drivers of BEV penetration? It's China. And they have announced further incentives to get old cars off the road or in order to stimulate their EV or new energy vehicles rather. And that eats market share from what could have been a PGM market. I think slight good pointers in the market are, it's very clear that there's a big push into the hybrids, plug-in hybrids, which will have combustion engines. Hyundai announced in their strategic review they're going to shift some of their BEV allocated production into hybrids as well, and that gives people some hope. I think important then already, but now as well, we're not expecting PGM demand to collapse from the automotive side. It's just going X growth and perhaps slight reduction, where previously we were concerned on particularly recycling volumes starting to hit the market. That is, luckily for the industry, not materializing at this stage. At best, it's flat. A lot of the recyclers we speak to are not seeing the volumes, and as a result, called the feared change to oversupply in, say, the palladium and rhodium markets is postponed. And that's why although prices are sharply down, they could have been down a lot more looking at the commodity macro environment, but also looking at what the recycling sector would have been able to collect and overwhelm the market. So in principle, I think we're seeing a pattern now where current prices will probably hold. And we have a bit of hope that next year those prices will see a bit of a slight recovery as our current timing of interest rate cuts should hopefully translate in some economic resurgence in 2025.
Okay. Obviously, you're talking there about general global growth, obviously shrinking, or I guess slowing since we last spoke there. And you spoke about other commodities, obviously, with things like nickel and lithium, obviously all in a bit of a tough time as well. But one of the differences with things like, say, for example, nickel or manganese or other metals is China quite strictly control the supply of those metals, and they don't not so much with things like platinum and palladium. Um, is there how how does this look in terms of the miner's perspective going forward? Because I think with things like rare earths and nickel and manganese, obviously, where most of the processing is in China, they tend to take a bit of a hit on the cost of the mining, so the downstream or the final product is cheaper, and they can sort of they can get away with it. I guess where most of the platinum is mined in places like Russia and South Africa, how bad are the miners hurting at the moment in this instance, and how long can they carry on in this type of price environment?
It's a very good question. I think the results are at the moment coming out. Northern was today, Impala yesterday. Engelplatz has already presented results, and we have Sabanya in the second week of September. And there's clearly cash burn going on, and they are also at the same time taking pretty harsh measures on either capital budgets, be it sustaining capital, be it expansion capital. The first operations are being put on care and maintenance, and there's called natural or voluntary retrenchments that are coming through to contain those costs. It is not easy to see that called the economic background or call it the revenue background changing dramatically over the next 6 months. We hope somewhere in 2025. South Africa specifically had an issue that currency is particularly strong at the moment. There's a lot of positiveness on and investment inflows back into South Africa that's helping the currency there, which is not good for miners. Some of the positives for the miners are that the power interruptions seem to have stopped, so they can produce more consistently. And in order to keep your costs down, it's very important to maintain volumes. And it's also the dilemma that we have in the PGM markets that in time, when we would probably need to cut some production, nobody wants to, because that immediately shifts you on the cost curve if you would be the one actually taking ounces of the market.
Is that a South Africa Pacific problem? Because obviously they're mining kilometers deep. Obviously, it's very expensive to that sort of underground mining. That's just specific to South Africa in terms of not being able to slow down production, or is that also?
It's in general, it's a general rule for any miner, I guess, is maintaining production is always helpful. Growing production is always helping to spread your fixed cost. South Africa is problematic for other reasons because of some structurally high costs, and we shouldn't forget that since 2019, costs of production in South Africa have doubled. And that is sticky costs. Your power cost, your labor cost, you can't wind that back. And that is making it very difficult as well to manage your cost base and hopefully maintaining it at inflation, but bringing it down is a big challenge. North America has very similar problems. Also had steep cost inflation, is much more dependent, we're talking now North American palladium and silver, on palladium income. And palladium is the metal that's been much harder hit than, for example, platinum. And as a result, their dependency on palladium price recovery is far bigger than what it is for the South African producers that have a broader basket to depend on. So there's a lot of strain in the North American market. North American Palladium has already, and that's owned by Impala, has made a decision. We're going to basically mine it out on an accelerated basis. So they will be shutting down over the next 2 or 3 years. Stillwater hasn't made an announcement yet, but obviously there's a risk because the cash burn is quite extensive as well. But it's quite a big mine in the Montana economy, so it's not so certain what you can do with that called strategic need to actually keep that mine going. But at the same time, we cannot continue burning cash forever. So it might have to take a partial decision of sorts, but that's not confirmed as yet.
What's the knock-on effect of this? Obviously, if we're having mine closures and it's becoming uneconomic to actually mine these materials, how long does the demand eventually outpace the supply with these mine closures?
Well, mine closure is one aspect of it. First of all, you need to see some, call it, demand sustaining, and the dependency on the global combustion engine is quite dangerous for particularly palladium and rhodium. That's 80 to 90% dependency, and although we can argue how structurally challenged that is based on people's belief in EV penetration or not, we shouldn't forget that there's still governments very strong belief that the transport sector has to start decarbonizing. We have the technology, the cars, and are becoming more competitive in time. The charging infrastructure will roll out. So there is this structural pressure that is not necessarily going to disappear because we have 1 or 2 years of poor growth. And there is still growth, we shouldn't forget as well. At the same time, primary supply is only is the other aspect. Yes, that can come down, but secondary supply is the one that is particularly worrying for us. I guess we have some breathing space at the moment because when in 2021 the prices rocketed, there was a lot of, let's call it pre-collection. Everybody that had some of these converters lying in their scrapyard managed to actually get rid of it. $80 to $85 a catalyst in the past, that shot up to $300, $400 per catalyst. There was a lot of theft of catalyst happening as well. And there has been a distinct shortage of new feed into the recycling sector over the last 2 years. A couple of reasons there. There was obviously the COVID disruption. A lot of people didn't drive their cars, so there's a bit of a lengthening of car life. There was also the value of secondhand cars shooting up after the chip crisis. So people found it easier to repair a car because replacing it with a new secondhand or a secondhand vehicle, those vehicles had shot up in price as well. And we had the interest rate rises that made leasing vehicles or owning vehicles a lot more expensive. So there has been a drag on actually getting cars scrapped and getting them to the scrap yards. And eventually that will start to balance out. We're seeing secondhand car prices already coming off. There's no hold up anymore in new car production at the moment, at least, depending on what China is going to do with their strategic mineral constraints. And we have, in principle, interest rate expectations coming down, which would hopefully allow people a bit more financial breathing space and potentially more ability to buy new cars or replacement secondhand cars. The one big if in that market is China. China, as central government, is looking at more means to raise taxes and is starting to hit the cash industries. One of those was the collection networks for converters. And they've introduced legislation that if you're a buyer of converters, you will have to report whoever supplies that to you to the tax authorities, essentially, and how much you pay this person. So a lot of this is suddenly going away underground, and there's a choking of the system. What is weighing against that is China's just introduced quite a large incentive program to get old clunkers off the road in order to stimulate the EV and NEV car sales. And we're trying to assess, okay, what is the net effect of that? Is this, well, let's call it the recycling industry potentially going underground, but the metal will pop up somewhere, going to be positive for net numbers? Is that also that incentive program accelerating cars going to the scrapyard in China? And remember, in all our forecasts, China started to catalyze cars properly 10 to 15 years ago. So it could really be that extra top up on the recycling volumes. And that metal will not come to the global market. China doesn't allow exports of precious metals, but it will reduce China as a buyer of metals. And it's been one of the biggest buyers in the past of these metals. So net, that could not necessarily help the overall PGM markets, but the timing of that is very difficult to put a finger on right now.
Okay, but it doesn't, I mean, in my mind, the way that you've painted that picture is obviously the recycling market will still be there. There's an incentive for, say, just for now, for China to recycle more of their auto cats. So at what point do we actually become, I guess we're a bit far out, but I guess it's not too unreasonable to ask, at what point does the market share of EVs counteract that of auto cats, and therefore the amount of palladium that's being recycled, you almost don't really need a mine supply? Because if 80-90% of palladium requirement essentially comes for vehicles, surely we will get to a point where we don't really need that much more of it.
Yeah, I think, Peter, that frankly is well out in the future, because even if you have fairly optimistic EV penetration rates, we're still seeing 70 million cars, combustion engine cars produced by 2040, be it in the form of hybrids, be it in the form of combustion engines going into the developing world that wouldn't have the ability to actually have EV charging networks because they're short of electricity in the first place. So there's going to be a very substantial combustion engine sales profile that needs to get catalyzed over the years. So that is not going to zero. Nevertheless, there is a period somewhere in the middle between now and 2040 where there will be a peaking of those recycling ounces, and they're not going to be insignificant. That is going to put a lot of pressure on the primary producers to get through. And that is where I guess we have to start thinking, okay, who will step back out of this market, even if it is for a period when we don't need those ounces, and who will survive financially through that period. The Russians are not going to disappear. They have PGM production that is byproduct. They have lots of nickel and copper revenues to live off, and those prospects look good. But the recyclers, will the incentive to recycle be there? We think it will be because it's a margin business. And yes, some recyclers will disappear, but the consolidation and the scaling of some of the remaining ones will probably keep them in business, although it's not going to be as lucrative as it was 3-4 years ago. Then you have the primary producers, and that's where probably there's going to be a lot of pressure. If you will see consistent pressure on actually costs going up, it's going to be very difficult to see everybody still financially healthy and around 10 years from now. There will have to be some correction there. And there are, I guess, natural attrition mines already in the system that are simply going to be mined out over the next 10 years. And that will start to, I wouldn't say rebalance the market, because I think palladium and rhodium prices are still seeing lots of volumes from the recycling sector ramping up. But it will give the others more chances of surviving. And that's why, well, let's call it the battle of the cost curve is going to become very intense over the next couple of years. How long can you actually sustain yourself through this tougher period that's coming ahead? And how do you come out at the other side?
I mean, we're a long way out, but what does the other side look like? I saw an advert recently, I think from Toyota, where they were advertising 4 different type of cars that they're able to produce. One of them, well, one was a combustion engine, one was a hybrid, one was a EV, and the other being hydrogen. Obviously, we haven't really seen much hydrogen penetration, but is there, if we're starting to see these solid state batteries that potentially might come through by the end of the decade, is there really a need for hydrogen? Is that really something that will be there in the future, do you think?
Look, it's a very good question, and I think the answers are certainly not 100% clear. I agree. Battery technology is moving at such a pace that it is starting to eat into applications which, let's call it 3 years ago, we thought was guaranteed hydrogen. And if you look at what will give PGM's volume, it's in the mobility sector. It's not building electrolyzers necessarily. It's in the mobility sector. You need to sell it into the trucking industry, the fuel cells. You need to sell it in the private car industry if you can. There probably will be some applications whereby you could see a percentage of car sales, percentage of truck sales go hydrogen, but you also should remember that there will be an offset against trucks that can do a great job with batteries. And to write off batteries in the trucking sector is premature. A lot of the trucks that are on the roads are not driving from Milan to Berlin and back again. They're driving in Milan to a shopping center and back to a depot outside Milan. They don't do 1,000 kilometers a day. They often do shorter distances, can recharge as a result. So a percentage of trucks will be perfectly capable of using batteries. Nevertheless, it is the hope that the platinum side, in particular, the platinum sector, will benefit from some hydrogen demand. It's just that number at the moment is in flux, and it makes it extremely difficult if you sit on the board of a primary producer where you need to commit capital, significant capital, to expand or replace a mine that currently is running out, and only see that volume 10, 15 years from now and seeing a return or hoped for return at that capital amount you're investing right now. And I think that's the struggle in the boardrooms, the uncertainty of the hydrogen volumes versus we know there's pain coming. Do we wait to spend that money and be too late, or see extreme prices in PGMs because we can't supply? It's an extremely difficult question to answer. We're doing a lot of work in the mobility sector and what are the options and opportunities. And it is important to stay completely on top of that because it's moving so fast. And I think what has shocked all the Western OEMs, the speed at which the Chinese are able to implement new solutions and jump technology-wise ahead of the Western world. And it's causing lots of drama at the US and the European called traditional manufacturers. First of all, they're seeing a very promising or past growth market in China getting outcompeted there by the Chinese brands themselves that are putting up very competitive offerings. And then they're starting to get attacked in their home markets. And that's why all the gates are going up and the barriers are getting thrown up. But it's a sign of things to come. And one of the positive aspects of that is if there's one region or country in the world that's stimulating hydrogen the fastest, it's China. At Shanghai Platinum Week, which was about 6 weeks ago, we visited a couple of those plants. They are very hard pushing hydrogen solutions where they can, and they want to be a winner in that technology again as well, and make that probably an export industry one day as well. And that could perhaps pull some of these hydrogen ounces or hydrogen industry related PGM ounces forward again. If China is as successful in EVs as it could be in the hydrogen space, it could really help call it the overall PGM industry globally as some of those call it efficiencies start to come up. These scaling benefits are coming through. Could they help the hydrogen acceleration? And that is something that we need to keep a close eye on.
Is there, obviously it wasn't too, I guess it still is. I mean PGMs, especially platinum, were often also seen as a precious metal. Do you see much demand similar to gold or silver, and in terms of demand for a currency hedge or anything along those lines that people might be able to start looking at platinum in a different way rather than just the industrial uses? Is that maybe a glimmer of hope for some of the miners out there?
Look, it is. It has traditionally already been an investment product for many, many years, and there's been traditional Japanese markets. There's some signs that the Chinese market is starting to open up to that now as well. We certainly have seen some increases in ETF investments as well to a certain extent. The difference with gold is now very large, and as a counter trade almost, you should suggest, okay, looking at strategically where this is heading, you should put some platinum away in your fold. So it is happening, probably not at the scale what we had hoped for, in a sense, getting dragged along with gold, because the Chinese investment public has really jumped into gold and is buying lots of volumes, either in jewelry format, and that is also, I guess, a bit disappointing in China. We would have hoped that the jewelry side would have been dragged along a bit, but the offering in jewelry is not as extensive as it used to be in China in particular. It's got to deal with an aging population and marriages coming off a cliff, similarly to Japan. So we don't have big numbers in for jewelry growth from that perspective. The Indian market looks still very promising, but probably not enough growth there to offset in the near term the Japanese and the Chinese pressures.
Okay. Well, I think that's a pretty good update. I guess if we were going to have another chat in say 6 months or 12 months time, I don't know, maybe looking into the magic ball a little bit. But I mean, where do you think we will be this time next year in this market? Do you think any changes really whatsoever? Are we still going to be under $1,000, both platinum, palladium?
Look, we do hope for a slight price recovery on the back of economic momentum building following interest rate cuts. But the effect of the interest rate cuts need to translate into new economic momentum, be it housing growth, car sales growth, investment growth. And that normally traditionally does translate in higher commodity prices. People will start to plan for that, will start to buy up commodities. We do hope, therefore, that prices, particularly platinum, will probably go above 1,000 if that actually materializes. That palladium doesn't necessarily recover strongly, but at least doesn't fall any further. And we should also remember palladium is, on a historic basis, is still a very good price at close to $1,000 an ounce. But at least we could see some momentum where it goes to 1,100, 1,200 for a short period of time. Structurally, the fundamentals haven't changed, but it's that momentum economically that could help them. And rhodium is probably going to be order magnitude where we are currently plus some, but not $10,000, $15,000. We don't see any reasons why that should happen unless there's a primary production hiccup of significant scale that then sometimes spikes rhodium, but we don't expect that to happen at the moment.
Okay, and just one thing I did forget to ask, it was how are stockpiles looking globally at the moment? I remember, I think it might have been a year or two ago, there was, it might have been the Platinum Institute or someone else was indicating that stockpiles are getting pretty low and they were expecting a pretty strong 2023, and it just never really materialized. Is there a problem with stockpiles, or do we have an abundance of them? How's that?
No, look, stockpiles is often a very vague definition, and people mix in different things in there. And we should remember, firstly, very few people, if any, disclose whatever they have lying in their vaults or having as working inventory. So they're more based on called momentum games. Platinum, looking at historically, there should still be lots of liquidity out there that can be materialized. And if demand would pick up, that can be easily satisfied. And that's been one of the reasons why platinum prices have stayed low. There was certainly in the post, call it Ukraine invasion period and the chip crisis, and called the general uncertainty that was created also by some of the deep load shedding in South Africa. There was definitely a pre-buying a lot of the riskier metals for the car manufacturers, palladium and rhodium, and that was reflecting in prices. That has started to normalize significantly. We still talk to OEMs. None of them are building or rebuilding inventories at this stage, that because of certain risk factors out there, they can easily access the metal. And as a result, we don't expect, or we don't see, if there would be a re-acceleration of economic momentum, there will be a certain amount of manufacturers that will step in the market. And that's also where we expect some of that modest uptake. It's not necessarily going to be killed off by, there's so much of this liquidity around, prices are going to go down despite all that economic momentum. There will be some positive price reaction. I'm quite convinced of that.
Okay. All right. Perfect. Henk, thank you very much for the update.
Thanks, Peter.